Well, the positive news this quarter was the fact that the NIMs have improved and shown quite a bit of expansion, 36 basis point this quarter. Do you think this is sustainable going forward as well?
Well, let me just start by saying that over several years, we have been systematically strengthening our balance sheet, improving the mix, redefining our risk appetite, and obviously working on some of the P&L parameters, which we thought were slightly off in comparison to some of the peers we compete with and want to be compared with. I think as far as NIM is concerned, in January of this year, we set up a team of very senior management people, and decided that we do need to get to our target of 3.8%, which have been guiding the market for some time, as quickly as possible. So we looked at every possible factor, like the asset mix, our pricing in the market, mix and kind of deposits we're going after, etc. I'm glad to say that the translation of what we want to do, which is to get to a NIM of 3.8%, and the outcome, I think the gap is coming down, or let's say the correlation is improving. And in that sense, Axis Bank is slowly, gradually becoming much more consistent and much more reliable in terms of its performance. Everything which we're trying to do in Axis Bank is for the long term, is for driving sustainability in the business, is for ensuring that once we achieve something, we stay there. I think we demonstrated that with asset quality, and you should expect the same with NIM also. While there are issues with the repricing of both deposits and assets, which is happening with a bit of a mismatch, and with all the volatility which is there. So it is not easy to predict NIMs quarter on quarter. But our intention has been that once we have got into this zone, we remain in this zone. NIMs could go up and down a little bit, but they're not going to go back to where we were for a long period of time. So yes, we do believe they're sustainable with some a movement up and down, but not substantial enough for people to say that we are no longer in the same zone. It is based on sustained effort made by Axis, and we intend to keep it there.
So let's not talk about quarter on quarter, right? Amitabh, tell me, what's the vision like going forward? Where do you see Axis Bank, say, 3 to 5 years from now? How big could it grow?
Well, again, that will be a bit of a guidance, but let me just make a couple of points here. One, when I had joined Axis Bank, I had said at that time that it is a great franchise, great set of people, great products, great recognition in the marketplace, and there is no reason why we should be placed where we are, which is number 3 in terms of our size, number 4 in terms of market cap. We should move up, and my intention as the CEO would be try to move Axis Bank up in terms of its ranking. And that's exactly what one has been trying to attempt over the last 3.5 years. COVID came away, so kind of it took us off track for some time because the priority had to change. But I'm quite happy and delighted with the fact that whatever we had decided to do as part of our, we decided to drive that change in our ranking through a GPS strategy, that whatever we decided to do as part of a GPS strategy, we are ticking more and more boxes. And as we tick more and more boxes, you will see our market share grow in many businesses. You will see our ranking move up, and hopefully it will get reflected in the size of our balance sheet and the size of our business, and it will also get reflected in our market cap over a period of time. Now, the rest is all speculation, but our desire and ambition definitely is not to stay where we are, but continue to move up. Now, India is a growing economy. India has huge and positive prospects going forward. So the Indian economy and the market is also supportive of very good growth going forward in the future. So rather than speculate as to where Axis will be 5 years down the line and start giving you numbers, I'm trying to give you a sense for what we want to achieve in terms of our overall ranking.
Right. So there are two issues with Axis, for the last couple of years, and you started by answering that, you have tried to repair the balance sheet, prepared it for growth. One is Opex, one is NIMs. You talked to us about the NIMs. Opex also came down this quarter. Will, going ahead, Opex increase from here on? What is the sense that you get in terms of Opex?
So we have been guiding the market on Opex that our cost to revenue will come down below 2%. We did achieve that. Last year, we allowed our expenses to run a little bit ahead because we thought there were opportunities in the marketplace to invest, and we should not let go of those opportunities because somehow we were committed to a number. We started investing in a big way in some of the very specific areas like credit cards and merchant acquisition and our retail asset business, Bharat Banking. We are going after a very large project on customer obsession, technology, analytics, a number of areas where we decided to invest. And because of the investment, our cost to revenue ratio did go up, but we remain committed to bring it down 2% to below 2% in the medium term, and that commitment remains. Our cost to revenue has moved down, and as we continue to work on cost to revenue, the cost to assets also needs to move down. Some of the best, some of the best ratios in the marketplace are below 40%. And ultimately, if we have to compete with all the players out there in the long run, we need to get to similar zone. I'm not, giving any indication here. I'm not even giving you a time in which we'll achieve this. But I'm just saying that ultimately, if we have to be amongst the best, our ratios across key business metrics also have to be amongst the best. And that's what we are committed to.
So also one more thing, when you compare Axis Bank to some of the other top tier banks, even though their loan book may be 2-3 lakhs higher than what you are currently, the size of their other businesses is also higher, whether we talk about insurance, whether we talk about mutual fund or any other businesses. But you mentioned that the economy is supportive of banking growth. So when it gives you leverage on the downside, what sort of leverage does only a pure banking play give you on the upside?
So we were, slightly late to setting up subsidiaries which were involved in the insurance and the mutual fund and the securities business. So because we were slightly late to the party, and I would credit my predecessor Shikhar, who actually led the way in terms of setting up a lot of these subsidiaries. I think one of the key elements of the GPS strategy was to scale up our subsidiaries. And I'm delighted to note that over the last couple of years, the scale up has been happening. The profitability of these subsidiaries when I joined was close to 380 crores. Last year, we reached close to 1100 crores. The scale up continues. And in that sense, we will do whatever it takes to ensure that some of these subsidiaries continue to improve their ranking and market positioning as the time goes on. Obviously, please also understand and appreciate that the investment in Max was a step in that direction. I also said that while the Indian economy is doing so well, India needs large banks and needs banks which can support the growth of this economy. We are very well placed as an Axis Bank and as Axis Group to not only support this growth in the economy, but also get the benefit of being a large player in this growing economy. And we obviously are trying very hard to build a platform which allows us to capitalize on this opportunity, which will come the way of every financial institution. We just want to create the right platform so that the growth which we get is obviously higher than what the industry is delivering. And that's precisely the effort has been over for the last couple of years.
Industry leading growth has been the key motto at Axis Bank, but the entire banking space seems to have hit a purple patch with credit growth now coming back to 10-year high levels of 18%. But so far, the bulk of the growth is coming from the retail side of it. What's your view of the credit growth going forward, and when do you see a pickup in corporate, loans as well?
Well, you captured it in the question itself that yes, the most of the growth which is coming on the credit, on the loan side is driven by the retail rather than the wholesale side of things. Whatever growth people are seeing on the wholesale side is more coming through refinancing and obviously supporting some of the investments which are happening through the government entities or government companies. My view is that as Indian economy, see, firstly, let's go back to the macro. The macro globally is volatile. We are seeing recessionary conditions, and because it is volatile and because all the action that is being taken by federal banks across the world, you might see a situation where recessionary conditions might continue for some more time, and ultimately India cannot be isolated from all this. So on one side, the macro seems to indicate that the overall recessionary conditions will bite India to some extent. Secondly, inflation rates are high, so RBI is also increasing its interest rates, and we expect a couple of more hikes to come in the next 6 to 9 months, which could also potentially dampen, CAPEX or loan growth. But on the flip side, the Indian economy is doing quite well. It is resilient. The government and RBI has been ahead of the curve, and they've been taking all the right steps to ensure that we actually deliver a growth rate which is much better than the world economies. And in that sense, while I remain optimistic, at the same time, as a typical banker, we have to be cautious of what could play out suddenly because of global factors. My view is that this loan growth looks sustainable over the next couple of quarters, but we need to be watchful. We need to be aware that it could get impacted very closely. Also, let's not forget the fact that deposit growth cannot lag loan growth. So if the deposit growth does not pick up, at some stage, it will have an impact on the loan growth also.
So, Amitabh, is it fair to then infer from what you are saying that 15 to 20% credit growth rate might not be sustainable in the medium term, let's say after a couple of quarters?
I'm saying that what I see today is that definitely for the next couple of quarters, it looks feasible. Beyond that is very difficult to predict. I'm not saying it will come down. I'm just saying there are too many factors at play. They're too unpredictable to be able to say with any level of surety that this will continue.
Talk to us a little bit about, Amitabh, what factors as of now, given that we are living in such a fast changing, ever so dynamic world, but as of now, given the where things are right now, what factors do you think that could impact this kind of a growth number that you just highlighted?
So let me give you a slightly more detailed answer. We expect, for example, US Fed to hike rates by another 150 basis points or more during the next few months. This is the fastest rate hiking cycle from Fed in last 3 decades. The mortgage rates, for example, in US have doubled over the last 90 to 120 days. Similar hikes are expected by ECB and BOE in the near future. Now, the full impact of this globally synchronized monetary tightening cycle remains to be seen. Monetary policy does work with a bit of a lag. And, given the size and the quantum of Fed rate hikes, obviously has increased the global market volatility. There are 3 spillovers of this: financial, commodities, and trade. India is already impacted. We have already faced the brunt of the first 2, and trade is forecast to be severely impacted, particularly in 2023. While RBI's monetary response has been on controlling domestic inflation, it has been complicated by external factors. They have had to intervene in the foreign exchange market for an orderly movement of the rupee. That has resulted in draining of the system liquidity, which has led to increase in money market rates, thereby increasing the cost of funds, and so on and so forth. So, I'm just giving you one example of how something has played out very, very quickly, where everything can't necessarily be controlled by India. So that's where my little bit of conservatism creeps in, that there are too many factors at play. There are too many global factors at play. And for us to say that nothing will impact India will be wrong on our part. And we, frankly, not only is a question of looking at that, yes, these factors could impact us, we need to be mentally prepared that this global volatility can come and hit India anytime. And it could impact our growth rates quite quickly, or it could impact our inflation quickly, or it could impact our interest rates quickly. And any of these factors will have an impact on, for example, loan growth rates. For example, they could impact the asset quality, because if the interest rates go up too quickly, the EMIs go up, and some of the customers might not be able to manage their EMIs over a period of time. So all of that needs to be watched. I don't want to sound pessimistic. Since you're asking me, I'm making these statements. I do remain extremely optimistic about how India is placed, how the government and regulators are managing it. And so I do see that India has a great story ahead, but I'm only just saying that we need to be watchful.
Okay, we'll take that. You're not sounding pessimistic. These are just warning signs. But yeah, I completely get your point. I mean, beyond a point, India is not going to remain resilient to all that's happening across the world. But let's now talk about, the Citi acquisition. While, of course, the opportunities are for everyone to understand. Tell me, do you continue to see challenges around customer retention at all? Or is that a smooth process?
So, since you asked me about the Citi acquisition, a little bit of update there. The CC approval is in place. We expect to close the transaction by end of the 4th quarter of fiscal 2023, which is the legal closure date. The integration management office with the steering committees in place, working across 17 work streams around people, technology, and business operations. The progress on customer communication, operational readiness, and performance of existing Citibank consumer business is trending in line with expectations. So, let me just, and the reason why I'm saying that is because, yes, there is the speculation in the market that, they're seeing a lot of attrition. First, when we did our valuation and when we priced the deal, we obviously took some attrition into account. The current attrition which we are seeing is in line with that valuation model. Secondly, we had a backstop that below a certain level of attrition or below a certain level of fall in business, there will be a change in valuation. But right now, given where the numbers are, we are nowhere close to that backstop. I think things are moving in the right direction. In some businesses, they're seeing some growth come through. So in that sense, some attrition happens in every business for every bank. It's not unique. In their case, they saw a little bit of spike, but now it has stabilized. And our view is that the acquisition should happen as planned, either by end of this fiscal 2023. And if tomorrow there is a little bit of spillover and we hit the year end, maybe a month or month and a half later. So broadly, things are on track.
Amitabh, but so CCI approval in place when it comes to the City merger, but there are red flags being raised when it comes to deal with Max Group as well. Could you clear the air for us? Is there any kind of overhang on that particular deal?
So first, let me start by saying that we are very committed to the Max partnership and our equity investment in Max. We would ideally like to, as we had envisaged in the original agreement, to increase our stake to close to 20% as and when we are permitted. When we did that particular transaction, it took a long time to consummate it. There were two separate agreements. One agreement finished, another agreement started. We consulted the regulator and shared all the agreements with them through the process. We believe we have done everything by the book. Regulator, after a certain period of time, has taken a different view of those transactions, and some of that is reflected in the order they have passed. We have a very long-term view of the insurance industry and our investment in Max. We obviously would like to work with the regulator to find the right solution. We are working with the regulator, and we are hoping that the right solution can be found. I don't want to speculate on what that solution would be, but our view is we did nothing wrong. We did everything by the book. The regulator has taken a view. We would like to work with the regulator and ensure that we move and look forward rather than keep looking, the history and say what went wrong and what potentially could have been done better.
Amitabh, you also flagged out how deposit rate has to go up, and it's meaningfully lower versus the loan growth. What's your expectation of what deposit growth can be going forward, and what kind of momentum are you seeing that?
Very difficult to predict on deposit growth picking up very quickly because we are seeing a complete withdrawal of the excess liquidity from the system. It used to be at peak almost close to 8 lakh crores. This is now down to less than 50,000 crores. So in that sense, with this withdrawal of liquidity, obviously the deposit growth has been impacted. My view is that this will continue for next couple of quarters. So every bank is scrambling for deposits. We believe that we started a transformation journey on the Axis Bank deposit franchise a couple of years back. It was all around rigor, rhythm, going after more premium deposits, going after the right set of customers, going after the right set of deposits also where the outflow is lower. Our deposit growth has been higher than the industry growth rate for the last couple of years. We do believe we can deliver on that going forward. There is enough opportunity within the Axis framework itself to continue to become more efficient and hit the right customers at the right time. So from my perspective, while obviously industry is seeing the deposit growth rate, which is lower, which might continue, we have enough things to do as Axis Bank. And that's what we are focused on. In the long run, deposit growth rate has to be higher than the loan growth rate. So either the deposit growth rate picks up or the loan growth rate comes down. So hopefully it will balance out. This is temporary where the loan growth is racing ahead of deposit growth rate. I think over a period of time, it will hopefully settle down.
Amitabh, you're sounding like one of the IT CEOs, cautiously optimistic.
It is I'm optimistic, but a bit cautious. I'm always an optimistic person. So, but yes, we are in the risk-taking business, so we should also always be thinking of risk all the time. But yes, I think our numbers show that even though we are cautious, there is enough which is available in the marketplace to deliver on. And that's exactly what we're trying to do in Axis, to build a more sustainable, granular franchise, which can deliver in the long run on a consistent basis. And hopefully the numbers in the last quarter demonstrated what this franchise is capable of delivering. We are hoping, obviously, we can continue this performance going forward in the future.
Right. So is that the message to your happy shareholders as well? The markets have been rewarding your stock off late, or is there something more that you would want to add?
No, I mean, I think we obviously, talk to the investors all the time. We have been giving them this consistent message over the last 3 years that we are building a granular franchise, which means that all the decisions we are taking are for the long term. It might mean a little bit of short-term pain, but in the long run, it will be great for Axis. We showed that with cleaning up of our balance sheet, strengthening of our balance sheet, improving our asset quality, which is now best in class. Now we are creating a P&L where the matrices are coming to close to best in class. You mentioned deposits. We need to get our deposit rates even higher than where they are. Our deposit growth rates higher than where they are. And I think once we are able to do that, I think it will be one of the best in class franchises in the banking system. And that's exactly what we're trying to create.
Okay, Amitabh, great to have you in the show as always. Thank you for speaking with ET Now.
Thank you. It's a pleasure, and thanks a lot, and happy Diwali to everyone.
Oh, yes, happy Diwali to you. It sure has been a happy one looking at your numbers.
Thank you. Thank you so much.